I'm covering today is future of Treasury, and also I will cover the latest product, uh, transformed product that we are launching in Treasury space, which is the Capital Q. There are two things I'm going to present. Before I go into details of this deck, I would like to share my experience, implementing Treasury at Citi and also at Reserve Bank of India. These two clients are quite key clients. One is a global bank where Citi has implemented our treasury solutions globally. And Reserve Bank of India is a central bank managing one of the largest portfolio for the government of India, closing almost managing $300 billion. The reason why I'm trying to share these two experiences is at Citi, our product runs in 36 countries and it manages on a yearly basis 120 trillion cash flows in and out from a liquidity management perspective for the treasurer. It's a place where we also have worked on a lot of risk models and we also have implemented an integrated solution over there. And at Reserve Bank of India, we manage 300 billion balance sheet of the portfolio of Reserve Bank. And there we have done a lot of work on portfolio analytics, portfolio optimization, and early warnings. So a lot of learnings from these implementations that I would like to share with you. Also in the morning, we saw two speakers, both Britt and Arun, talk about some of the design principles that are relevant today. One is customer centricity. Second is integrated platform. And third is actually enabling systems to service the customer better. So these two things I would like to connect, these two dots, and talk to you about the future of treasury. Did you know this, that focusing on liquidity, risk, and balance sheet can boost the net interest income by 10 to 15% and reduce balance sheet consumption by 10 to 20%. Now, treasury typically, in most organizations, focus on trading, focus on investment and risk management. Yes, they do focus on asset liability management, but it is more a reactive process than a proactive process. The trends that we are seeing in the market is whichever treasurers focus more on liquidity risk, balance sheet risk, steers the balance sheet in a better way. And this is no less than said by Boston Consulting Group, Chartis, who are leaders in analyzing liquidity, treasury, and risk management. So what is causing this change? So as I said, balance sheet risk management in most banks has been a reactive process, and the treasurers want to move towards more of a proactive process. And the reason for doing that is if the treasurer comes to know about the risk earlier, he can act better on that. So for example, when I say reactive process, things like can I do pre-deal analysis prior to doing, say, a large loan transaction? Can I look at what is the impact of this loan on net interest income, liquidity ratios, impact on funding risk, etc. This kind of analytics is now being sought by business as well as the treasurer. That's the reason why the importance has come to manage liquidity and balance sheet risk management more on a proactive basis. Treasury is the nerve center of a bank, which actually collaborates with the business units, offers its balance sheet to the asset business and the liability business, or at a predetermined price, what we call fund transfer pricing, and then also manages the market risk of these resources on a continuous basis. So what it really needs to support such an environment is an integrated treasury platform which has got the same data sets which is used for trading, for investment, for risk management, for stress testing, simulation, regulatory compliance, and also support customers in the treasury services space. So the integrated treasury platform is what could help the treasurer to become more proactive. So there is a shifting focus, as I mentioned, from not just managing the P&L and risk on trading and investment portfolio, but also to contribute significantly in balance sheet risk management, into liquidity, and thereby improving the net interest income. So, for example, we have seen, in situations where treasurers have said that we have met the funding plan or the funding targets. But say, for example, the loans business has not taken off or it's dipping. It is the job of the responsibility of the treasurer to rebalance those extra funds to a more revenue earning uh, avenues. So this is where the treasury gains a lot of advantage by getting data earlier on the risk side and actually act on it. So it's very important that all the critical functionalities which treasury today needs is integrated and given in one platform. The second things that we have seen that is happening in the market, some of my customers have called me and asked, for example, in HDFC Mortgages, which is one of the largest, runs the largest balance sheet in India in the mortgage businesses. They have a typical problem where they are in the loans business. Typically, most loans follow a pattern, follow a schedule, so you know how to project the cash flows. But they have close to almost 30% prepayments actually. So this disturbs their matched liquidity profile. And this is where they actually want to use AI models, machine learning to actually help them to predict prepayments more with higher level of confidence. This is one area that we have seen. We also have seen customers asking us, particularly we have a customer who focuses on agricultural and rural development, running a very, very large balance sheet. So they lend loans to customers with an optionality, a 5-year loan, but repayment anytime after 3 years. So these are products where you cannot really forecast, what kind of prepayments can come. So this is where your AI machine learning can come a big play and give an advantage to help them to predict the cash flows on a more accurate basis. So there are about 6 levers which is available to treasurer to influence. In many banks, we have seen there are multiple systems which cover these 6 areas. And what it really happens is in this data challenges for any analytics that you want to do or any simulation you want to do. And even for regulatory compliance, becomes very difficult. For example, PRA 110, which is a UK regulation for liquidity risk. They want impact of liquidity risk on interest rate risk being provided at a very granular level to the PR to regulators. So having two systems, one catering to liquidity and another catering to interest rate risk, makes the life of the treasurer very difficult. So he has to arrange all this data together and then analyze it. So it becomes more cumbersome, more challenging, etc. So that's one trend that we are seeing. Second thing is, if you look at it, trading and investment is a very key function for a treasurer. So some treasuries do run large portfolios. So portfolio analytics, portfolio optimization becomes very much important so that they can change the portfolio compositions based on risk and various other parameters. The second one, which is very important, is the digital FX, which I believe is quite a very big requirements in this market. Is actually to offer FX services to your corporate retail clients. And in this, one of the most important things that we are saying is providing FX visibility first, providing an analysis of what is hedged, what is not hedged, then providing tools to hedge the FX is one of the key functionalities that we have got. And it's a very, it is an excellent product in terms of cross-selling to your corporate and retail clients. That's what we call as the digital FX. The third area is actually liquidity. So if you predict liquidity with a higher confidence level, your investment and borrowing can be optimized and your cost of funds or NIM can be improved. The fifth area is regulatory compliance. As I said, when we implemented City Treasury at 36 countries, we have learned the very detailed nuances of implementation and regulatory needs of each of those countries, which have got incorporated in our product, so which we leverage. The last but not most important is the risk management. It's actually integrated risk management across liquidity risk, interest rate risk, credit risk, particularly if you are conversant with IFRS 9 or current expected credit loss. These are important to measure what is the impairment losses and make adequate provision in the balance sheet. The second area is actually to do with front office review of trading book, which is actually concerned more about whether you are adequately capitalized, the market risk on your investment and trading portfolio. The other important point I wanted to talk about is also analytics, actually. So when you see the demo tomorrow or today, we have actually embedded the balance sheet risk analytics into various banking applications. So you can, for example, we have an ALM system, you build analytics on top of it, you can make it available to various banking business units. Say for example, you can offer that analytics to your deposit business or the loans business for them to do some kind of pre-deal simulation. You can offer the same analytics to the treasurer actually to manage the balance sheet risk more effectively. When we talk about simulation, there are regulatory stress testing, regulatory simulations. Yes, I think we have to comply to that. But there are bank-specific simulations which are very interesting, and typically ICO or typical senior management would like to review that. Examples could be like deterioration of FX rates. Suppose you are predominantly your balance sheet is FX driven, then deterioration of FX rates could be quite useful. Or if you want to look at if there are asset growth and P&L growth, what is the impact on funding risk, NIM, etc. Or if you have a loans portfolio which is, say, migrating in ratings, then what is the kind of loss you can expect? Or decline in security prices. These are the kind of simulation one could actually run. And most importantly, see it in a more integrated fashion. Now today, if you really look at risk is actually interconnected. So for example, if there is a liquidity gap, it's quite possible when you do a repricing of those gaps, tend to pay more interest, which will have impact on your NIM, or you will have an interest rate risk, and vice versa. Similarly, capital credit risk and market risk would lead to more risk-weight asset, thereby asking for more capital charge and more liquidity to be provided in terms of high quality liquid assets and all. So it is very important that these simulations are run considering all the risks, various types of risk, so that you can actually do more better predictive analysis and more prepared to take care of the risk in the balance sheet. So the new models that we are talking about is integrated treasury, market risk, and balance sheet risk. The balance sheet risk management is more forward-looking actually. So we try to provide what is to be done in market risk. Generally, market risk previously were more post-trade. Then it shifted around 2018-19 to pre-trade actually. More some of you are in the treasury space. So similarly, trends are happening where people are trying to do balance sheet risk management more pre-deal than post-deal kind of stuff. So that's the shift that we're seeing. So if you with the combination of balance sheet risk management as well as ALM, you arrive at what kind of a planned gap you are looking at. But the actual gap could be very different from the planned gap. Then you do the hedging in your treasury product, and then also offer your treasury as a service to the various clients. And the analytics cuts across the various banking units as well as treasury, so that the integrated solutions offer the same view to the various banking units members, so that they can manage the risk better. So when I started off saying that focus on liquidity, balance sheet, NIM, along with trading and investment, is a model which the various analysts and consulting firms are recommending today, and they're saying it gives you a major advantage over other peers in the market. Sorry. So I'd like to at this point of time introduce Capital Q. As you see, there are 6 facets of functionalities that we have in Capital Q. It is designed to integrate the 6 levers available for treasury to create a stronger impact. As I said, we run Citibank Treasury globally in 36 countries. Close to 52 banks actually in the growth markets, IMEA and APAC, use our product actually in various modules of Intellect Treasury. So Q has, we have completely transformed. We have actually brought all the various levers integrated in one platform. We have also revised the UX to offer more easy access. We provide a lot of analytics. You'll see that in a short video that I'm going to present. And we differentiated the market in the sense like nobody gives us so much focus on balance sheet risk like as we do today. So our differentiator with other treasury product is integrated treasury market risk and balance sheet risk. The learning that we got it from Citibank, the learning from learn from Reserve Bank of India, etc. So this is what is FlexCube. Sorry, Capital Cube is. I'm going to give a short demo of the product.
Treasury is the heart of the bank. However, an ecosystem of disparate solutions is really hampering our goal of strategically contributing to the bank's growth. Managing liquidity buffers, real-time risk management, the absence of insightful analytics, while maximizing profits have always proven to be challenging. I wish there was a single platform to manage all these challenges. Introducing Intellect Capital Cube, an intelligence-driven integrated real-time treasury and risk system aiding rapid decisions. With Intellect Capital Cube, you can strategically manage the balance sheet, adapt to regulatory regimes, optimize liquidity and leverage risk to maximize profits for the bank. By bringing together the levers of Treasury, CBX FX, ALM, capital adequacy, analytics, risk management. Treasury, integrated front to back office leading to higher operational efficiency. User configurable screens with pre-deal analytics and decision support blotters lead to informed decision making. Real-time position updates across branches to optimize liquidity with timely hedging. Configurable workflow management resulting in high STP. CBX FX, increasing the customer engagement index to fuel business growth. With CBX FX, you get real-time access to streaming rates from multiple liquidity providers. Instant liquidity for banks customers with a B2C model. Direct customer interaction to hedge your positions for better risk-return outcome. Ease in generating increased fee-based income for the treasurer. ALM, 360-degree view of balance sheet and beyond, anytime. With ALM, you can monitor liquidity risk with a consolidated view of trading and banking book and drill down at cost center levels. Perform profitability analysis through liquidity and interest rate risk analysis. Analyze the impact of interest rates with behavioral scenarios and stress test the entire balance sheet. Capital adequacy, real-time monitoring of regulatory capital requirements. Capital adequacy helps you visualize changes in LCR for short-term liquidity risk management. Monitor long-term liquidity risk and solvency through NSFR. Analyze additional metrics through monitoring tools to adapt to jurisdictional peculiarities. Analytics, business insights for better decision-making. 21 decision-supporting analytics and many more. With analytics, you can identify risk, measure and monitor positions for optimal leveraging through 150+ risk metrics. Assess impact of volatility and market changes with scenario analysis. Risk management, from managing to leveraging risks. Comprehensive market risk metrics for simulations and VAR analysis. Ability to manage the entire counterparty credit risk, resulting in operational cost benefits. Intellect Capital Cube transforms your treasury, resulting in liquidity optimization, maximized profitability, operational efficiency, insightful decision-making, expansion of customer base, and ensuring compliance. Intellect Capital Cube, enhancing the strategic potential of treasury.